Audit deficiencies by accounting giants grew in latest inspections, U.S. regulator says. What up, my nerds? Welcome to another Villains of Accounting video. Today we are going to discuss the alarming trend in audit deficiencies in the financial statement reports audited by the Big Four accounting firms. Then we'll talk about a potential solution to this problem. According to a report by the PCAOB, which is the regulatory body for the audit industry, the Big Four had an average deficiency rate of 24% for 2021 audits, which was up from 13% for 2020. Now, before we dive a little deeper, I want to briefly talk about what audit firms do and what an audit deficiency is, just in case some of you don't know. If you're an investor or a lender, you want to increase the odds of getting your money back plus a return, right? Well, that's where auditors come in. They perform various types of testing around transactions and controls over the accounting process to provide enough assurance to say, hey, these financial statements are basically accurate. Audit firms can't test 100% because that would take too long and the firms wouldn't make any money. So they do just enough to form an opinion on whether their clients' financials are correct. Now on to audit deficiencies. So an audit deficiency is basically when a firm does not gather enough evidence to support their opinion on the issuer's financial statements. Now, this doesn't mean that their opinions are incorrect. It is possible that despite obtaining insufficient evidence, their opinions on financial statements are still accurate. They could get lucky, in other words. But their chances of audit failure or issuing a clean report when there's actually a material misstatement increases the more audit deficiencies they have. So as you can see, all Big Four firms have been trending upward. However, you can probably tell that one firm stands out, and that is EY. EY had an abysmal deficiency rate of 46% compared to 21% in the prior year, which is still pretty bad. So what specifically do these firms suck at? Apparently it's auditing controls over financial reporting and your basic substantive testing. Very simply, controls over financial reporting are processes that ensure the company is properly recording transactions. Substantive testing is when an audit firm looks at evidence that proves a balance is accurate or a transaction took place. For example, an invoice is pulled to show that a sales transaction actually occurred at the amount the company claims it did. So back to the deficiency rate. It was 24%. This is pretty discouraging, right? The firms responsible for auditing the largest publicly traded companies in the world have ridiculously high deficiency rates. And auditors are supposed to safeguard investors from false or misleading financial statements. So what can we do? Right now, the PCAOB does not report which companies had the higher rates of deficiencies, only the audit firms themselves. So nobody knows which earnings report is riddled with audit deficiencies, sometimes including the client. The PCAOB has suggested 3 options to increase transparency. First, the PCAOB could disclose in the inspection reports the identity of issuers where the audit deficiencies occurred. Second, the PCAOB could disclose in the inspection report for each firm a complete list of the issuers whose audits were inspected that year. Third, they could publish on a regular basis a list of all public companies whose audits were inspected. This would at least provide insight into the PCAOB's engagement selection process and provide greater accountability to investors and other stakeholders. Apparently, the SEC, which enforces the rule that public companies issue audited financials, didn't like the idea, arguing that the affected company's stock prices could take a hit. This is the SEC we're talking about here. The agency was created to protect investors from fraud and market manipulation. But hey, they're kind of right. There's no telling how many companies have questionable financials with supposedly clean audit opinions. All of their stocks could possibly tank if that was ever released. Imagine the outcry not only from wealthy investors, but those middle-class retirees that depend on their stocks performing well. It's unfortunate we're in this position, but perhaps we need a clean slate if we actually care about the truth and well-regulated markets.